There are certainly a number of considerations to keep in mind when deciding how to structure your next financing round. For example, choice. If you've been meeting with a potential lead investor, the lead may dictate the financing structure if you don't propose the structure from the outset. Certain investors will only invest based on certain structures. Some institutional investors, Sophie for example, will only invest based on their standard loan agreement. Another consideration is cost. Raising an equity financing is often more expensive than raising convertible debt, safes, or a pure loan financing from a legal perspective. For example, equity financings will almost always require you to implement or update your shareholder agreement in articles, which typically isn't necessary in the context of a convertible debenture financing. If you're raising less than $1 million, we would recommend you raise funds by issuing safes or convertible debentures. Finally, valuation. Do you have a company valuation in mind? If not, then it may be easiest to raise by issuing debt or convertible debt, which allows you to delay the determination of your company's valuation until a future priced round. You may also avoid diluting yourself heavily early on by raising equity on a very low company valuation. But be careful of valuation caps and discounts. If you are raising a large round on convertible debentures with a low valuation cap or a high discount, you may suffer heavy dilution at the time of your next equity financing. Speak to your startup lawyer about modeling in what a cap table would look like on a future financing round.
What are the differences between safes and convertible notes? One difference is that a safe does not have a maturity date. A convertible note will have a specified maturity date upon which the loan under the note is either to be repaid or is converted into shares in the capital of the company in accordance with the terms of the note. Safes also do not accrue interest, whereas a convertible note will have a set interest rate that accrues over the term that the loan is outstanding. Another main difference is in conversion scenarios. A safe will convert into equity shares of a company on a future financing event as specified in the terms of the safe. A convertible note can convert into shares under multiple scenarios, including into existing shares of the company, at the option of the holder, on a future financing event, and at the maturity date. The amount and class of shares that the note converts into will depend on the scenario that it converts under. More generally, a safe is a simpler form of instrument, hence the name Simple Agreement for Future Equity. A convertible note is a more traditional form of security and involves more complex terms and in many cases increased investor protection. Either can be appropriate to use depending on the stage of the company, the amount of funds raised, and the requirements of the investor.
Now that you've landed your first external financing round, what are some common terms that you should think about? This is heavily dependent on the type of structure you've selected for your round, whether that's a convertible note or an equity round. For example, in a convertible note or a debenture round, you should think about whether that note will be secured or unsecured. Think about how it will rank in terms of existing and future indebtedness. Think about your maturity date, your events of default. Think about what the interest rate will be and the conversion features of that note, whether optional or automatic triggers. Think about, for example, whether it will be based on a cap, a discount, or both. In an equity round and a priced round, things are a little bit more nuanced. Not so much in a common share round with friends or family. Not much changes on the legal structure there, and your share capital is essentially the same as your founder voting common shares. But for example, for the purposes of this analysis, let's assume that you've landed your first external financing round with a VC that is selecting preferred shares. Most key provisions generally relate to issues of economics or control. Some common terms that you'll want to think about and negotiate early with your lawyer in the term sheet are around ranking, dividend preferences, liquidation preferences, and whether those are participating or non-participating preferred shares, conversion mechanics, anti-dilution, voting and protective provisions for the preferred share class, redemption rights, board composition, and whether that investee will have a nominee right and how that interplays with the current management control of the board, and other major investor rights such as observer, information rights, preemptive rights, and ROFR and co-sale rights.
When raising your first equity financing, there's no exact number you should be striving to maintain post-closing. Rather, this is very dependent on your near and long-term financing plans. If you foresee multiple rounds of financing before the company can generate enough revenue to fund its own operations and scale effectively, you will want to ensure you hold enough equity after closing such that you can continue to absorb further dilutive hits moving forward without investing your own money to participate in the later financing rounds. You don't need to hold 51% of your company's equity to maintain control of the corporation. It is common for founders to hold 20% or less, and sometimes much less depending on the size of your founding team and how many external fundraising rounds you've been through at the time of an exit. Based on the company valuation, it is important to founding teams and investors alike that the founders are adequately incentivized and aligned with the potential success of the company. Despite the ownership percentage, founding teams can ensure they maintain control of their corporation's management by retaining the right to appoint a majority of their board for as long as possible. This is done by utilizing a shareholder agreement or a voting agreement. Even if you hold 10% of the corporation's shares but have the right to nominate 4 or 5 board members, for example, you will control the day-to-day operations and management of your corporation. And you can also ensure proper approval thresholds and founder protective provisions are implemented from a shareholder perspective.